The total U.S. national debt has crossed historic levels, raising serious questions among economists, investors, and policymakers. For years, borrowing was cheap. Interest rates were near zero, debt servicing costs were manageable, but that environment has changed. Now, the U.S. government is spending hundreds of billions annually just to pay interest, not to build roads, not to fund defense, not to invest in innovation, just to service existing debt. Because debt doesn't trigger crises overnight. It builds slowly, until one day markets decide it matters. And the higher rates remain, the heavier that burden becomes. Some analysts warn that if debt continues rising faster than economic growth, it could limit government flexibility during the next crisis. Others argue that because the U.S. controls the world's primary reserve currency, it can sustain higher debt levels longer than other nations. But confidence is the key variable. If global investors ever question America's long-term fiscal stability, borrowing costs could rise further. That pressure markets, slow growth, and potentially weaken the dollar. Right now, there is no collapse, there is no emergency declaration, but the trajectory is what concerns economists. Because debt doesn't trigger crises overnight, it builds slowly, until one day markets decide it matters. The question isn't whether the U.S. can handle debt today. The real question is, at what point does the world decide it's too much?